While most investors are panicking about the market drop after the tariff announcement, Vanguard's economists are running sophisticated algorithms through future scenarios to prepare for the 2025 market conditions. In this video, I'm breaking down critical insights from Vanguard's recent client advisory, information that directly impacts the investment decisions right now. Their team has identified a significant disconnect between economic indicators and stock market performance that few are discussing. If you've been wrestling with whether to stay invested or move to safer options, these perspectives from their global chief economist Joe Davis offer valuable guidance for navigating today's uncertain markets. When the market dropped after the tariff announcements, did your stomach drop too? You're not alone. That sudden 10% levy sent shockwaves through the investment community, triggering a market downturn that had many investors frantically checking their portfolios and questioning their strategies. This reaction is completely natural, especially if you're new to investing and haven't weathered many economic storms yet. What's happening psychologically during these market drops is fascinating, and understanding it could save you thousands of dollars in costly mistakes. For younger investors especially, who might be experiencing their first major market correction, that portfolio notification showing a significant drop can trigger genuine physical anxiety. Your heart rate increases, you feel that knot in your stomach, and suddenly all you want to do is pull everything out before it gets worse. This emotional response can lead to decisions that directly contradict what financial experts consistently recommend. The overwhelming urge to sell and protect what's left of your investments often result in locking in losses and missing the eventual recovery. This isn't just anecdotal. Research from Dalbar's quantitative analysis of investor behavior shows the average equity fund investor has consistently underperformed the S&P 500 by several percentage points annually over 30-year periods, largely due to poorly timed buying and selling decisions driven by emotional reactions to market events. In practical terms, many investors end up buying high when markets feel safe and selling low when fear takes over. Consider Alex, a 28-year-old who started investing during the pandemic. When markets first dropped in 2022, she immediately sold half her portfolio. "I couldn't handle seeing my account balance drop day after day," she explained. "Now I realize I lock in losses and miss the partial recovery that followed." These internal fears are amplified by the modern media ecosystem. Scroll through your financial news feed during the market drop and headlines scream "market crash imminent" or "your portfolio is doomed," creating a constant stream of anxiety-inducing content. These sensationalist headlines generate clicks but rarely provide balanced perspective. What gets less attention are historical patterns showing that markets typically recover and continue their upward trajectory over time. You might be asking yourself right now, am I making a mistake by staying invested? Should I be doing something different? This uncertainty is particularly pronounced with the recent tariff announcement because they introduce variables that impact global trade in complex ways. Unlike some economic events that affect specific sectors, tariffs ripple through supply chains, consumer prices, and international relations in ways that can be difficult for even experts to fully anticipate. What's especially interesting about the current market reaction is the unexpected scale and scope of the tariffs that caused the downturn. As Vanguard's analysis indicates, the market was shocked by how extensive these tariffs turned out to be compared to initial expectations. This highlights the critical aspect of market volatility. It's often the gap between expectations and reality that drives the most significant market movement. While most retail investors are caught with this emotional whirlwind, Vanguard's team approached the situation differently. Rather than reacting to market sentiment, they systematically analyze data points, run complex scenarios, and evaluate historical patterns to understand what this volatility actually means for long-term investors. Their approach reveals something crucial. These periods of uncertainty, while uncomfortable, are normal features of healthy markets, not bugs to be feared. By maintaining a systematic approach rather than making emotion-driven decisions, investment strategies can capitalize on opportunities that emerge during volatile periods while maintaining focus on long-term objectives. Have you ever wondered why your portfolio doesn't move in sync with the economy? This counterintuitive insight from Vanguard's global chief economist Joe Davis might be the missing piece that explains why your investment timing never seems to match economic reality. When you hear troubling economic headlines, your instinct might be to check your portfolio immediately. But Davis offers a powerful framework that challenges this common reaction. He uses a compelling analogy that transforms how we understand these two systems. When you think of economy, think like an engine. It moves slowly. While when you think of the market, think of it as the mood. It reacts quickly and sometimes overreacts. Like a car's performance isn't judged by a quick start, but by consistent output over distance. The economy demonstrates its strength through sustained performance rather than immediate reactions. This distinction has profound implications for your investment strategy. The economy operates like a massive engine with numerous interconnected parts. It's powered by jobs, inflation rates, consumer spending, and business investments. These components change gradually, sometimes taking months or even years to show significant movement. When unemployment rises or manufacturing slows, these shifts unfold at a measured pace visible in quarterly reports and annual statistics. The stock market, however, functions more like a mood barometer, sensitive, reactive, and often amplifying sentiment beyond what current conditions might warrant. It reflects what might happen 6, 12, or 18 months from now. This forward-looking nature creates what appears to be a disconnect between economic reality and market movements. This misalignment explains why investors make critical timing errors. They react to concerning economic indicators by selling investments, only to watch markets recover before economic improvement, or they wait for confirmed economic recovery before investing, missing substantial market gains that occurred in anticipation. The COVID-19 pandemic illustrates this principle dramatically. In early 2020, the S&P 500 plummeted 34% in just over a month. Economic indicators were grim. US GDP contracted by 3.5% for the year, and unemployment reached 14.7% in April. Yet, while millions remained unemployed and businesses still shuttered, the market began recovering. By August 2020, amid continued economic distress, the S&P 500 had fully recovered its losses. By year's end, it reached new record highs even as the broader economy struggled. Economic indicators didn't return to pre-pandemic levels until mid-2021, with labor market recovering extending into 2022. This wasn't irrationality. It was the market pricing in future recovery expectations. Investors who sold during the March crash based on economic news missed one of the fastest market recoveries in history. This pattern repeats across economic cycles. Markets typically decline before recessions are officially declared and start recovering while economic data still looks terrible. By the time economic indicators confirm trends, the market has already incorporated that information. Understanding this dynamic changes how you might interpret Vanguard's current analysis of tariffs and their potential impact. While economic effects of trade policies unfold gradually over months or years, markets react immediately based on anticipated future implications. This perspective shift gives you a powerful advantage. Instead of making decisions based on today's economic headlines, recognize that markets have likely already incorporated that information. Your focus can shift to longer-term trends and fundamentals. By understanding this fundamental separation between economic reality and market movement, you're better positioned to leverage Vanguard's predictive strategies and maintain discipline during market volatility, a crucial skill we'll explore in our next section. The gap between what most investors see and what institutional investors detect is much wider than you might realize. While you might track a handful of economic indicators or follow financial news, Vanguard's investment strategy group simultaneously processes hundreds of variables through sophisticated scenario modeling. This computational advantage allows them to spot early warning signals of market shifts that won't make headlines for months, sometimes even years. Remember the emotional roller coaster we discussed earlier? Vanguard's computational power helps navigate these turbulent waters with precision. Behind the scenes at Vanguard, teams of analysts run complex algorithms processing thousands of data points simultaneously, examining how these factors interact across global economies. Their system recognizes patterns too subtle for individual investors to detect. Think about your own investment research process. You might track inflation rates, follow Federal Reserve announcements, or read quarterly earnings reports from companies you're interested in. These are valuable inputs, but they represent only a tiny fraction of these variables that truly drive market movements. Meanwhile, Vanguard's system monitors these same factors plus hundreds more, including cross-market correlations, historical pattern recognition, and complex economic relationships that signal market shifts well before they become obvious. What makes this computational advantage powerful is how it enables comprehensive scenario modeling. Vanguard runs sophisticated simulations of potential market conditions, modeling everything from tariff escalations to recessions in foreign markets. Like meteorologists using supercomputers to predict weather systems that haven't formed yet, Vanguard's algorithms provide predictive insight for market conditions, analyzing how events might cascade through interconnected global markets. These models provide crucial context unavailable to most individual investors. When news breaks about economic developments abroad, Vanguard has already examined how these events might affect global markets. This allows strategic rather than reactive positioning, with allocations based on probability-weighted outcomes rather than headlines. What are these algorithms currently seeing? While specific outputs remain proprietary, Vanguard's analysis suggests continued volatility through 2025, with important nuances. This volatility won't affect all market sectors or geographic regions equally. Their model accounts for potential domino effects of various economic scenarios, including possible recessions in markets outside the US that Joe Davis has mentioned. Take Maria, a teacher who invests a modest portion of her salary each month. Though she lacks advanced market analysis skills, her Vanguard Target Date Fund gives her access to the same sophisticated analytical infrastructure guiding trillion-dollar decisions. She benefits from institutional-grade market analysis without needing to understand complex algorithms. The practical value isn't about timing market entries or exits. Instead, it helps Vanguard position their funds to weather various conditions while maintaining exposure to long-term growth opportunities. Their algorithms identify both risks and potential areas of resilience that might not be obvious to standard analysis. You can access these benefits without replicating Vanguard's computational infrastructure. Their low-cost funds allow you to outsource complex predictive modeling while maintaining control over your overall investment strategy. With fund fees as low as 0.08% and minimum investing starting at $1 or $3,000 depending on the fund, Vanguard makes institutional-grade market analysis accessible to everyday investors. This accessibility represents significant democratization of financial information. Just decades ago, this level of analysis was available only to the wealthiest investors and largest institutions. Today, Vanguard's funds allows you to benefit from the same sophisticated analysis that guides the market's biggest players. All the algorithmic advantages in the world won't help if you make emotional decisions when markets turn volatile. While sophisticated models can predict trends, what really determines investment success isn't perfect timing, but having a framework that keeps you steady regardless of market conditions. This is where Massey Williams, Vanguard's head of wealth management, offers something invaluable: 4 principles designed specifically to help investors navigate uncertainty without succumbing to panic. When markets plunge, fear takes over. Investors obsessively check portfolios, consider withdrawing money entirely, or freeze with indecision. Williams' framework addresses this emotional response directly, shifting your focus to what you can actually control and transforming market volatility from a source of anxiety into a manageable part of your investment journey. The first principle Williams emphasizes is ensuring your investment goals align with your personal circumstances. Your age, financial situation, and individual risk tolerance should dictate your investment strategy, not market headlines or what others are doing. Someone in their 50s approaching retirement might prioritize capital preservation, reducing exposure to riskier assets. Meanwhile, a younger investor with decades ahead can weather short-term volatility for potentially higher long-term returns. Think of this as tailoring a suit. What fits someone else perfectly might be completely uncomfortable for you. Your goals evolve over time, and your portfolio should adapt accordingly. The second principle focuses on building a balanced, diversified portfolio that spreads investment across different asset classes, regions, and sectors. This strategy works as a buffer against volatility's impact. Williams explains that diversification prevents you from experiencing the full impact of any single poor investment. When one area underperforms, another may compensate, smoothing out your overall returns. It's the investment equivalent of not putting all your eggs in one basket, a simple concept with powerful protection against market turbulence. The third principle, maintaining a long-term perspective, becomes easier with proper diversification in place. Markets will always fluctuate, but history shows that patience typically rewards investors who stay the course. Consider the investor who panicked during the 2020 COVID crash and sold everything, missing the remarkable recovery that followed within months. Keeping costs low forms the fourth principle in Williams' framework. Even the most brilliant financial advisor cannot exempt your portfolio from market downturns, but minimizing fees means you keep more of what you earn. Vanguard offers funds with fees as low as 0.08%, compared to many actively managed alternatives charging 1% or more. Over decades, this difference compounds significantly, potentially adding tens of thousands to your retirement savings. Williams recommends having a support system, whether a friend or coach, to help you stay committed to your plan when emotions run high. The ability to look beyond the short-term emotional behavior of the market is key to long-term investment success, she notes. This discipline separates successful investors from the crowd, helping them avoid impulsive decisions based on fear or greed. Together, these four principles form a comprehensive system that works in any market condition. Rather than trying to predict exactly what will happen next, you're equipped with a framework that makes those predictions less relevant to your success. Whether markets soar or plunge, your strategy remains intact, guided by principles rather than reactions, transforming how you experience market volatility. So, what's Vanguard's real prediction for 2025? At its core, it's a human forecast rather than a market one. Success is largely within each individual investor's control, as Massey Williams insightfully notes, cutting through market noise to investment success essence. While market swings remain beyond our control, our response isn't. Your discipline during volatility ultimately determines your performance. Investors maintaining perspective during turbulence consistently outperforms those making emotional decisions. Markets will continue their natural rhythm, short-term fluctuations with long-term growth. By embracing Vanguard's framework, you're equipped with your true competitive edge, a steadfast approach that can transform market uncertainty into opportunity.